All right, let's get right into it. Today we're going to pull back the curtain on a really powerful strategy that the pros use all the time to keep more of their money working for them instead of sending it off to the tax man. It's called tax loss harvesting, and honestly, it's a lot simpler than it sounds. But first, to really get why this matters, you have to understand the sheer scale of the problem we're talking about. Every single year, investors in the US pay about $300 billion in capital gains taxes. That's just a staggering amount of money. And the crazy part is, a huge chunk of it is, well, it's completely unnecessary. In fact, even the most conservative estimates say that investors are leaving at least $45 billion on the table every single year, all because they're not using the very strategy we're about to break down. I mean, think about it. That's money that could be growing and compounding in their own accounts.
And this really shows the gap, right? While the big players, hedge funds, huge institutions, they've been doing this for decades, a whopping 87% of individual investors have never even tried it. And we're here to help change that.
Okay, so let's shift gears from the problem to the solution. How does this so-called secret actually work? Well, when you boil it down, it's all about turning your losses on paper into real, tangible tax savings. At its heart, tax loss harvesting is exactly what it sounds like. You strategically sell an investment that's down in value. Now, the point isn't to give up on that investment, not at all. It's to officially realize that loss so the IRS lets you use it to your advantage. Let's make this super concrete with an example. So let's say you had a great run with Stock A, and you sell it, locking in a nice $10,000 profit. Normally, you'd owe capital gains tax on that entire 10 grand. But you also have Stock B in your portfolio, and it hasn't done so hot. It's sitting at a $6,000 loss. So what you do is you sell it, and you harvest that loss. You make it official. And here's where the magic happens. The IRS lets you subtract your losses from your gains. So instead of paying taxes on the full $10,000, you only have to pay taxes on the net amount of $4,000. And just like that, you've seriously cut your tax bill. Now, there's a specific order to this that the IRS lays out. First, your losses cancel out your investment gains. But, and this is awesome, if you have more losses than gains, you can then deduct up to $3,000 against your regular income, from your job. And any leftover losses after that, you get to carry them forward to use in future years indefinitely. That's like having your own personal tax savings bank account. Okay, this all sounds fantastic, I know. But there is one major rule you absolutely positively have to follow. It's called the wash sale rule, and if you ignore it, you can basically undo your entire strategy. So, what is this critical rule all about? Well, it's the government's way of making sure you're not just playing a game, selling something just to claim a tax loss and then immediately buying it right back. The rule says that if you sell something for a loss, you can't buy back a substantially identical security within a 61-day window. That's 30 days before the sale, the day of the sale, and 30 days after. If you do, the IRS says, nope, sorry, and they disallow that loss for the tax year. Now, that key phrase here is substantially identical. So, selling Apple stock and immediately buying more Apple stock, yep, that's a wash sale, total no-go. But selling Apple and buying Microsoft, not a wash sale. Or, a really common one, selling an S&P 500 fund and buying, say, a total stock market fund. They're similar for sure, but they're not identical, so it's perfectly legal. And that's how you stay in the market while still banking that loss. And hey, listen up, because this is a pro tip that can save you a massive headache. The rule applies across all of your accounts. That means your spouse's account, your IRA, even your 401k. So if you sell a fund at a loss in your main account, but your 401k automatically buys it a week later, that's a wash sale. And the worst part, if the repurchase happens in a retirement account like an IRA, that tax loss is gone forever. You can never use it. It's a huge trap to avoid. So how can you actually start doing this without getting totally overwhelmed? Well, there are really two main ways to go. You can automate it or you can do it yourself. On one hand, you can use a robo-advisor, and a lot of them automate this whole process. They scan your portfolio every day and just do the trades for you. It's a fantastic set it and forget it option, especially for beginners. On the other hand, you can do it manually. This gives you a lot more control and is probably better for larger or more complicated portfolios. It just means you need to check in a few times a year. If you do go the manual route, a really simple but powerful way to do it is the paired securities strategy. You just pick two funds that are similar, but not identical, like the ones you see here. When your main fund is down, you sell it to get the loss and then immediately buy the replacement fund.
This way, you stay fully invested in the market, but you've also banked a really valuable tax asset.
So after all this, what's the real payoff here? I mean, is it really worth the effort? Well, in a single year, sure, it's a nice tax deduction. But over an entire investing lifetime, the impact it's just transformative.
Just look at this. Seriously, two identical investors both start with $500,000. The one who doesn't harvest ends up with $3.2 million after 30 years. Not bad. But the investor who consistently harvests their losses, they end up with $3.9 million. That's a $700,000 difference just from being smart about taxes. And the reason for that huge difference is the magic of compounding. See, when you save, let's say, almost $5,000 in taxes in year one, you don't just pocket it, you reinvest it. And that reinvested money then starts earning its own returns, creating this amazing virtuous cycle of wealth that just grows and grows over time.
So here's the final thought I want to leave you with. Market volatility isn't something to be afraid of. It's just a permanent feature of investing. The ups are what give you your gains. And the downs? Well, the downs give you these incredible tax loss harvesting opportunities. It completely reframes how you look at a down market, not as a crisis, but as a chance to actually improve your long-term returns. The market will always have ups and downs. The real question is, are you using both?